All right, looks like we're at time, so let's go ahead and get started today. Thank you for joining us for the October 27th, 2025 Around the Valuation World International Webcast. Before we get started with today's webcast, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during the webcast today. If you have a ABW International subscription, you'll receive the CP certificates in your NACP.com portal within 7 to 10 business days after today's webcast. With Around the Valuation World and the Valuation World International, we try to keep our members updated on all the hot topics in the industry. With the time frame that we have, we don't have enough information or enough time to go over all the information that's available. So there are some links to the Value Examiner Quick Read, Journal of Forensic and Investigative Accounting, and also the European Business Valuation magazine, if you are interested in reading more about some of the hot topics in the industry. Our team of editors is Wolfgang Mies, Andrew Newman, and Pratik Shah, with Brian Jones as the advisor. During the webcast today, we'll go over some GACV news items as we always do. With our industry headlines, there was a change to our presenter. So today we actually have Achille Ekeu joining us with the impacts of tariffs on small business valuation, risk, realities, and best practices. And just with the GACV news items, I just want to let you know that we do have the AVW in-depth session. With the in-depth webinars, what we do is we pull one topic from our monthly webcast and elaborate on that in a full-length webinar, so you can get more information if you're interested about the topic. So those are the two topics we have coming up. And also, if you're interested, there is that QR code on the page. So go ahead and scan that or visit the website that's down below. We also have the annual Edge Virtual Summit coming up in December. So if you are interested or need CPE for recertification at the end of the year, that's a good opportunity to take some courses to obtain the CPE credits you need. So scan that barcode or visit that nacv.com/summit for more information. And in addition to that, we do have some AI webinars coming up. There is a free AI primer available. It's coming up also later this year. So if you are interested in any of those AI topics, I encourage you to scan that code and get some more information on that as well. And with that, I'm going to turn it over to Wolfgang briefly, who can give us some more information about the upcoming EACVA conference.
Yeah, thank you, Chanda, and welcome to everybody. Our 18th conference in Europe will be held on 13th and 14th of November in Munich. Unfortunately, it is sold out since weeks, so I can take the chance to introduce you on our next conference in Germany. If anyone has plans to travel to Europe next year, November would be a good time to combine it with a conference. Our conference will be held in Berlin, November 19th and 20th. And if your plans to Europe are a little bit earlier, we can have the first announcement on this. We will have a second conference, a smaller one-day conference on Monday in July or June. It's not finally fixed, in the beautiful city of Prague in the Czech Republic. Yeah, having said this, Chanda, I think we can step forward. Yeah, it's a great pleasure for me to introduce Ekeu. He is for a long time the well-known member of NACVA, former state chapter president of the Washington, D.C. and Maryland. He was elected board members for the Valuation Credential Board, and now he's the founder and the CEO of the Washington Valuation Group. He's accomplished as author, public speaker, advisory board member, dedicated to empowering business data-driven valuation insights and financial strategy. And today we have a highly interesting topic on tariffs, and you all know that over the last years we were hit with lots of macroeconomic developments and changes compared to the last century. So now we have to deal with tariffs, and Achille brought some real case studies with him, and yeah, I'm looking forward to your presentation, Achille. Having said this, I would hand over to you.
Okay, good morning, everyone. Thank you for joining us for this presentation. I'm going to share my slides here.
Yep, perfect.
Okay. Okay. Is it good?
So you trying to put it in presentation mode? Is that what you're doing?
No, I want to still see my notes on the side.
Because we really like to put it on full screen mode. So if you do, I think it's slideshow. It's probably the easiest way.
Yeah. Okay, slideshow. Okay, let me go to slideshow here.
Yep.
And then
then
play
from start. Yeah.
Okay.
That
All right. That's good. All right. So thank you very much, everyone. The global trade environment has undergone dramatic transformation since 2025, from the beginning of 2025, with the implementation of sweeping tariff policies that have fundamentally altered cost structures, competitive dynamics, and risk profiles across industries. As we see, the weighted average US tariff rate has surged from 2.2% to over 17% under aggressive policy scenarios. This represents the highest level since the early 20th century. This unprecedented shift has created significant challenges for business valuation professionals who must now incorporate complex trade-related uncertainties into their analytical frameworks. So traditional valuation methodologies developed during a period of relative stable international trade require substantial modifications to address the multifaceted impact of tariff policies. These impacts extend beyond simple cost increases to encompass supply chain disruptions, competitive repositioning, currency volatility, and broader macroeconomic effects that can fundamentally alter a company's value proposition and risk profile. All right, so we are going to move ahead with the next on the slides now, since I've set the stage up. Okay. All right, this is the agenda of the day. It's a little dense, but we're going to try to go through it as quickly as possible. And we will take questions at the end because this is a study and I want to make sure that everybody gets enough information before we start talking, before we start asking questions. All right, so what are tariffs? Tariffs are tax imposed on imported goods. They are often used to protect domestic industries from foreign competition or serve as leverage in trade negotiations. While tariffs may aim to boost domestic production or reduce trade deficit, they can also disrupt supply chains, increase costs, and create market uncertainty. So these factors directly influence the financial health of small businesses. All right, so let's look at the current tariff environment. So on this slide, we're highlighting the major shift in the US tariff landscape for 2025, and these shifts have profound implications for business valuation professionals like us. The average US tariff rate has jumped 20%, as you can see, the highest level since 100 years. So just put that in perspective, it was only 2% prior to 2025. right? So this kind of spike has immediate and material effects on cost structures, especially for businesses reliant on imported goods. So next, note the 30% from 145% cumulative increase in tariff on Chinese imports implemented in May 2025. So this is reshaping global trade flows and creating added complexity in supply chains. The effects are already being felt on the ground. 67% of small businesses surveyed are expecting negative impacts from these tariff increases. This means tighter margins, cost pressures, and in many cases, a need to reprice products or services, key variables in our income-based valuation models. So economically, the estimated impact is stark. We're looking at a projected $160 billion annual reduction in GDP due to these trade disruptions. So that translates into lower consumptions, reduced business investments, and broader economical uncertainty. On the key development, we can see that the tariff rate increase is sharp and unprecedented, requiring valuation professionals to reassess the risk profiles of businesses with foreign exposures. China's share of US imports has dropped from 22% in 2027 to just under 14% in 2024, showing how businesses are already shifting their sourcing strategies. And finally, supply chain diversification is accelerating. While this can create longer-term operational resilience, it typically comes with short-term costs and risk, which we need to carefully factor into our valuation approaches. So let's go to understanding tariffs mechanisms. All right, this slide is going to help us break down how tariffs translate into financial implications for businesses and ultimately into the numbers we use in valuation. All right, so let's look at the tariff impact flow here. When a tariff is imposed, it increases import costs. That forces companies to make tough business decisions. Whether do they absorb the cost or do they pass it on to consumers? Or, switch suppliers altogether. So these decisions lead to a measurable financial impact, which is where our valuation work comes into play. Now, looking at the table below, we see four main types of tariffs, each with its own implications for businesses or for business valuations. The first one is ad valorem tariff. These are based on the percentage of an import's value. The business impact is variable cost increase. So as prices rise, so do tariffs, right? So from a valuation standpoint, we need to assess revenue and margin sensitivity. How exposed is a company's bottom line to fluctuations in import values? The second is specific tariffs. Second type of tariff, specific tariff. These are a fixed amount per unit regardless of price. This creates a predictable cost per item, but it hits harder for lower priced goods, right? So here, our analysis needs to focus on volume impact. For example, can the company maintain its sales volume under this cost pressure? The third type of tariff is compound tariffs. Here is a combination of percentage-based and fixed components. Right? So that leads to a more complex cost structure, especially for products with wide price variability. For valuation, this requires detailed scenario modeling to capture how different pricing or sourcing strategies might play out. And the last type of tariff is the retaliatory tariffs. These are reactive measures, right? So usually in response to tariffs imposed by other countries. The business impact is often a loss of export market access, as foreign demand may fall necessarily. In our valuation, we need to account for market diversification risk. For example, can the company pivot to new markets or is it locked in? So, big picture, Tariffs don't just affect costs, they alter strategies, cash flow, risk profiles, and assumptions we use in every valuation model. Understanding the mechanism behind the tariff allows us to more accurately model the financial implications. Direct financial impacts on business operations. So here we outline how recent operational changes are affecting business finances, focusing on cost increases and their broader financial effects. Let's look at cost structure changes. Raw materials. There's an estimated increase of raw material costs between 15 and 25%. This is rising due to supply chain issues and global demand. It affects production costs and final pricing. And then we have finished goods that is estimated to increase, but the costs are estimated to increase between 8 and 15%. This is driven by labor, it's driven by transport, as well as processing cost. It reduces profit margins. Then we have supply chain restructuring that is estimated to increase by 20 to 35%, right? So this affects companies investing in resilience, for example, new suppliers, facilities, automations, right? So, and there's a high upfront cost, but that is critical for long-term stability. Then we have working capital that is also affected, estimated between 10 to 20%. So this is a longer lead times and higher inventory that needs that needs, there's a need for longer lead times and higher inventory that at the end strains cash flow. Then let's look at the primary financial impacts. EBITDA compression is estimated between 5 and 15%, especially for import-dependent businesses. This is caused by rising input and operational costs. There's also cash flow volatility, which is higher working capital needs that create liquidity challenges. Then we have capital expenditure that's increased investment in supply chain diversification and technology. And then we have competitive positioning or competitive position. Here, pricing pressure threatens market share, and innovation and partnerships can help maintain the edge. So these financial pressures require proactive management, right? Cost optimization, cash flow control, and strategic investment to ensure resilience and competitiveness. Okay. So let's look at the valuation methodologies. Here, we address how traditional valuation methodologies must be adapted in light of ongoing tariff-related disruptions and broader operational shifts. So let's look at the DCF. Look at the table. We have valuation methodology, key adjustments, and specific considerations. The first one is DCF analysis, right? So revenue forecasts and cost structures need recalibration to reflect higher input cost and potential pricing constraints. WACC should incorporate updated country risk premiums and capital structure assumptions. Scenario modeling is essential, especially around the duration of tariffs and their impact on terminal value. Second, we have market multiple adjustments. Multiples may compress, right, due to margin pressures. Industry-specific adjustments are necessary. Comparable selection must account for import exposure, right, geographic revenue mix, and supply chain adaptation or adaptability. And then we have asset approach adjustments. Inventory values and replacement costs must factor in inflationary pressures and sourcing changes. We have to consider obsolescence risk and foreign asset impairments. And intangible assets tied to market access or sourcing advantages should be reevaluated. So, critical considerations. We have to distinguish temporary tariff effects from structural changes in trade policy and supply chains. We have to evaluate management's ability to adapt operations and margins under pressure. We have to understand the company's competitive positioning and financial flexibility to absorb shocks. And we have to recognize that valuation is increasingly scenario dependent, requiring deeper due diligence and judgment. So in the tariff impacted environment, valuations demand more nuance. We have to adjust methodologies appropriately, ensuring that appraisals remain reflective of real-world risk and resilience factors. Those are critical for credible conclusions in today's evolving landscape. So let's turn to this slide, industry-specific impact analysis. Here, we highlight how tariff impact different industries, categorizing them by the exposure levels, and providing specific examples with quantifiable effects on cost, revenue, and valuation multiples. All right, so let's look at the high exposure industry. We have two types of high exposed industries, manufacturing and retail consumers, the one in red and the one in orange. Then we have the medium impact industry and low impact industry. So let's talk about the high one. Manufacturing for manufacturing, the primary tariff exposure are raw material dependency, right? So we talk about steel, aluminum manufacturing, right? So the industry impact is estimated between 15 and 30% increase in raw material cost. In terms of valuation adjustment, there's a compression of between -20 to -35% that is estimated. In terms of for retail or consumer industries, the primary tariff exposure for that industry is imported goods reliance, right? So we talk about consumer electronics in general. The impact is estimated between 8 to 20% increase in component sourcing cost, right? So in terms of compression for valuation adjustment, is estimated between -15 to -25%. Then we have medium exposure industry, technology companies in general. Their primary tariff exposure are component sourcing, right? So we talk about apparels, textile, things like that. The impact is estimated between 10 to 25% increase in finished good costs. And in terms of valuation adjustment, there's a compression that is estimated between -20 to -30%. And we have low exposure industry. Those are service companies, right? The primary tariff exposure is very limited very limited in terms of direct exposure. We can talk about industry like agriculture export, for example, or other service industries as well, or the service companies as well. And the impact is estimated between 5 to 40% revenue loss due to retaliatory tariffs, right? And so in terms of valuation adjustment, it's a compression of -10 to -50%. So in general, what we see is that when tariff hit manufacturing and retail, when tariff hits, they hit harder manufacturing and retail consumer industries the hardest. These industries are highly dependent on imported raw materials or components, right, leading to significant cost increases. And valuation multiples are adjusted downward substantially, -20 to -35. Technology faces moderate exposure, and the valuation adjustment reflects this moderate exposure as well. Services have limited direct exposure. Services are less directly affected by tariff, but can still suffer from indirect impacts like retaliatory tariffs. The range of impacts varies widely, reflecting industry-specific nuances. In terms of revenue loss and cost increases, while manufacturing and retail consumer primarily face cost increases, while agriculture export experiences revenue loss due to retaliatory tariffs. So industry-specific impact analysis. Oh, sorry. This is case study. All right, case study. So we have a case study of an ABC company that is operating in a manufacturing steel component, operating in the manufacturing industry, and then it's a steel component producer. it's a mid-sized manufacturer of industrial components. 60% of raw materials are sourced from China, and the impact of tariff is estimated at 25% as to quarter to 2025. So what's going on here? We see that in terms of revenue is declining. A 10% drop in revenue is due to higher input costs and potential pricing pressures. We have gross margin compressions as well. Gross margin falls by 13% or 13 percentage points, reflecting increased cost. EBITDA reduction is half, showing significant profit erosion. And valuation multiple contraction, we see in terms of valuation multiple contraction, we see that the multiple decreases by 26%, which indicates reduced investor confidence. In terms of enterprise value, where this plunges, right? Enterprise value is going to drop by 63%, highlighting the severe financial impact. In terms of valuation adjustment made, now, to account for tariff impact, some adjustments have to be made, right? And 3-year transition period for supply chain diversification. That's the first change that we need to make, or the first adjustment. We have to recognize the time that's needed to shift sourcing away from high tariff regions. So that's why it takes about three years to transition. There's an increased WACC by 150 basis points for execution risk. This reflects the added risk associated with implementing supply chain changes. There's a reduced terminal growth rate by 50 basis points for competitive pressure. This acknowledges the competitive challenges faced by the company. Applied marketability discount for industry uncertainty accounts for broader uncertainty in the manufacturing sector. So let's look at this second case study. This is a retail distribution company. This slide is going to detail the analysis of the financial and strategic impacts of tariff on an Ekeu distribution, a regional distributor of consumer electronics and home goods. So what do we see here? Where there is a baseline of $25 million that is being determined for that company in terms of revenue impact. And so the baseline in 2024 is $24 million. So the revenue drops from $25 million, I'm sorry. The revenue drops from $25 million to $20 million in 2025 due to price absorption, reflecting the company's decision to absorb tariff costs to retain customers. There's a partial recovery in 2025, meaning that revenue have slightly improved to $21.3 million as the company start passing some costs on to customers, indicating a partial price pass-through strategy. And then further recovery in 2026, revenue increases to $22.5 million in 2026, suggesting that the company has adapted its sourcing and pricing strategies to mitigate tariff impacts. So let's look at the strategic response and valuation impact. So there's an immediate impact, right? So margin compression is the first immediate impact. So margins are compressed by 8 to 12% due to higher costs and limited ability to pass them on to immediately. There's a short-term strategy. That means that supplier diversification, it has to be done. The company reduces, by doing so, the company reduces dependency on international suppliers by diversifying its sourcing, which helps mitigate future tariff risks. And there's a medium-term strategy, which is a customer-based consolidation, for example. Here, the company focuses on retaining high-value customers by reinforcing its value proposition, ensuring long-term customer loyalty. As to valuation adjustment, there's a discount that needs to be applied, and a 25% discount is applied to the company's valuation for an 18-month transition period to account for the uncertainty and adaptation phase. So this case demonstrates how tariff can significantly impact a retail distribution company's revenue and margins. By absorbing costs initially and gradually implementing price adjustments, the company mitigates short-term losses. However, the broader strategic shift, such as supply diversification and customer base consolidation, are critical for long-term resilience. The application of a 25% valuation discount reflects the transitional challenges and uncertainties faced during this period. This approach is going to ensure that companies' valuation accurately reflects its current situation while accounting for its adaptive strategies. Now, we'll talk about tariff risk assessment framework. There's a poll. So here, we outlined a multi-factor risk analysis framework that is designed to assess the impact of tariffs on businesses, right? So it categorizes various factors into low, medium, and high risk levels. It assigns weight to each factor and provides guidance on how to interpret the resulting risk scores in terms of valuation adjustments. All right, so let's look at this multi-factor risk analysis. So the framework evaluates six key risk factors, each with defined threshold for low, medium, and high risk levels. The weights are assigned to reflect their relative importance to assessing tariff-related risk. Let's look at the first risk factor, import dependency. A higher percentage of imports indicates greater exposure to tariff, right? So businesses with less than 20% import dependency are considered low risk, while those with over 50% are high risk. The second one is geographic concentration. Diversification across multiple countries reduces risk. Reliance on a single country increases vulnerability, right? So that is an important element as well, important risk factor. Then we have supplier alternatives. Having multiple suppliers mitigate risk. Relying on a single supplier exposes the business to significant disruption. Then we have price elasticity, right? Products with low price sensitivity can absorb cost increases without losing demand, whereas high price sensitivity means customers may switch to alternative, impacting revenue. Then we have financial flexibility, another risk factor. Here, strong financial health allows companies to absorb shocks, but constrained resources limit a company's ability to adapt. And last risk factor, we have management capability, right? So experienced management teams can navigate challenges effectively, whereas limited experienced management team increase the risk of mismanagement during disruptions. All right, so once we do the assessment, then we have to total the score. And now we have to be able to understand what the score means, right? So a low risk score is a score that is between 1.0 and 2.0. This one here, there's a minimum valuation adjustment that is required. The discount range between 0 to 10%. When we have a risk score between 2.1 and 3.5, it's considered a medium risk. So moderate adjustment that is needed, and the discount ranges from 10 to 25%. And then we have a high risk company that has a score between 3.6 to 5.0. Here, there's a significant adjustment that is required, and the discount can range between 25 and 50%. So the risk score reflects the overall vulnerability of a business to tariff impacts. Valuation discounts increase proportionally with higher risk scores, indicating the need for more substantial adjustment to account for increased uncertainty and potential losses. Now, let's look at the business mitigation strategies and valuation impact. Here, we are outlining the key mitigation strategies businesses can adopt to reduce the impact of tariff and other disruptions, along with the implementation timelines, cost investments, valuation benefits, and risk reduction levels. So the first strategy is supply chain diversification, right? Here, it requires a longer implementation timeline that's estimated between 12 to 24 months. And in terms of cost, it involves significant investment of between 5 and 50% of revenue. It offers substantial valuation benefits that's estimated between 10 and 20% uplift and high risk reduction. So this is an excellent position to be, an excellent strategy. Then we have domestic sourcing shift. This takes about 6 to 18 months to implement, right? So it involves moderate cost increase between 3 to 8%, and it provides moderate valuation benefits that is estimated between 5 to 15% uplift and a medium risk reduction. Then we have product mix optimization. This can be implemented relatively quickly, between 3 to 12 months. It involves low cost and it offers moderate valuation benefits, estimated between 5 to 10% uplift and medium risk reduction. Then we have operational efficiency. This takes 6 to 12 months to implement. It involves moderate investment between 2 to 5% of revenue, and it provides lower valuation benefits between 3 to 8% uplift and low risk reduction. Then we have the final contracting, the forward contracting, right? So this can be implemented immediately. It affects working capital, but does not involve direct cost increases. It reduces volatility, offering medium risk reduction. So in terms of valuation credit for mitigation, the first one are announced plans, right? Announced plans recognizes 0 to 25% of the potential benefit. It indicates that while plans are promising, they have not yet been executed or proven effective, right? So, it's an interesting strategy here. In terms of progress implementation, it recognizes 25 to 75% of the benefits. It shows progress and commitment, but full value is not realized until completion. Then we have completed implementation. This recognizes 75 to 100% of the benefit and demonstrates successful execution and tangible results. And finally, we have track record factor. Here, it emphasizes the importance of management's past execution history. A strong track record enhances credibility and increases the likelihood of recognizing higher valuation benefits. Okay, let's look at scenario analysis framework. All right, this is a framework that was designed to evaluate the potential impacts of different tariff scenarios on business performance and valuation. It outlines 4 key scenarios: the base, the bull, the bear, and the stress. And it provides insight into their respective probabilities, tariff levels, revenue impacts, EBITDA multiples, or EBITDA impacts, and valuation multiples. Additionally, it highlights the probability-weighted valuation approach for assessing these scenarios. All right, so let's look at the first scenario. So the base case, or the current tariff scenario, it assumes no change in current tariff levels. So there's a moderate impact on revenue and EBITDA with a slight volatility. Valuation remains relatively stable with minor fluctuations. The bull case, so tariff reduction or tariff removal, it positively impacts revenue and EBITDA due to reduced cost or increased demand. There's a high probability of position or positive outcomes leading to significant valuation uplift. The bear case is the case of a tariff escalation. Here, there's a negative impact on revenue and EBITDA due to higher costs or reduced demand. There's a moderate probability but significant downside risk leading to substantial valuation declines. And finally, we have the stress case, which is the case of trade war escalation. This is an extreme scenario with severe tariff increases. There's a low probability but catastrophic impact on revenue, EBITDA, and valuation. Now, let's look at the probability-weighted valuation approach. So, these slides outline key principles for incorporating scenario analysis into valuation. The weight scenario by assessed probability and time horizon. All right, so the weight scenario assigns weight based on likelihood of each scenario occurring and the time frame over which it is relevant. We have to consider, then we have to consider correlation with broader economic conditions. Here we evaluate how external economic factors may influence the likelihood and severity of each scenario. Then we have to adjust discount rates for policy uncertainty. Here, we increase discount rates to account for higher uncertainty in future cash flows under less favorable scenarios. And finally, we have to include option value for management flexibility. All right, so here we recognize the value of management's ability to adapt strategies dynamically in response to changing conditions. So the scenario analysis framework provides a structured approach to evaluating the potential impacts of different tariff environments on business performance and valuation. By assigning probabilities and quantifying financial impacts, businesses can better understand the range of possible outcomes and make informed decisions. The probability-weighted valuation approach ensures that these scenarios are integrated into the overall valuation model, accounting for both upside potential and downside risk. So this holistic perspective helps stakeholders assess the resilience of the business and plan for various contingencies. All right, DCF model adjustment for tariff impact. So this slide outlines how discount cash flow model needs to be adjusted to account for the impact of tariff on a company's financial projections. It focuses on three key areas: revenue projections, right, cost structure modeling, and discount rate adjustments. So let's look at the first component, volume growth. Traditional methods rely on historical trends and general market growth. Tariff-adjusted approach incorporates demand elasticity and competitor responses to better reflect potential changes in customer behavior due to price increases or supply disruptions. Then we have price realization. The traditional approach considers inflation and pricing power. Now, the tariff-adjusted approach evaluates whether companies can pass on increased costs to customers and assesses market acceptance of higher prices. Then we have market share, right? So the traditional methods focus on competitive positioning, but the tariff-adjusted approach considers how relative tariff exposure compared to competitors affects market share, as companies with lower exposure may gain an advantage. All right, let's look at the cost structure modeling. Direct costs. This includes input cost inflation and the extent to which tariffs are passed through to customers. Indirect costs account for increased supply chain complexity and compliance requirements. One-time costs consider restructuring efforts and the costs associated with qualifying new suppliers. Working capital factors in changes in inventory levels and payment terms due to altered supply chains or cash flow dynamics. So, tariff introduce additional layers of complexity in cost structures, requiring careful modeling of both direct and indirect impacts, right? So, one-time costs related to restructuring and suppliers qualification are critical to capture as they represent significant upfront expenses. Working capital adjustment ensure that changes in inventory management and payment terms are reflected accurately. Working capital adjustment ensure that changes in inventory management and payment terms are reflected accurately. So discount rates adjustments. All right, so here we're going to look at the beta adjustment, for example. It reflects increased sensitivity to trade policy as tariff can lead to greater volatility in cash flows. Let's look at country risk. This incorporates geographic revenue or cost exposure, acknowledging that different regions may face varying levels of tariff risk. And then we have policy risk premiums. This adds a premium of 50 to 200 basis points depending on the level of tariff exposure. And finally, execution risk, which considers the ability of management to adapt to changing conditions, as effective execution can mitigate some tariff-related risks. So overall, we see that the importance of adjusting the DCF model to account for tariff impacts across revenue projections, cost structures, and discount rates is critical. By incorporating demand elasticity, cost pass-through capabilities, and tariff exposure comparisons, businesses can develop more accurate revenue forecasts. Let's look at market multiple analysis in the tariff environment. So we look at EBITDA, enterprise value to EBITDA multiple compression by import dependency. We have low imports that's estimated less than 20%. Right? So EBITDA multiples is estimated to be 8.5x. When it goes down to 6.2x, it's considered medium import. This is for medium import companies and that are estimated between 20 to 50% in terms of exposure. Well, what happens to EBITDA? It goes to 6.2x. And for high imports companies, their EBITDA goes down to 4.1x. And for China-dependent companies, it goes down to 2.8x, right? So in terms of industry, we have different criteria, right, that we have to, apply here. The first is industry. And here we have to look at traditional comparables. We have the same SIC code or next code. Tariff adjusted comparables should be probably the same, plus similar tariff exposure. So low import dependency are companies with minimal import reliance, right? Just like we just mentioned earlier. Then we have, in terms of selection criteria, we have the size. Traditional comparable consider revenue and asset size, right? Tariff adjusted comparables also factor in financial flexibility, which is crucial for managing tariff-related risk. In terms of geography, traditional comparables look at market presence, whereas tariff-adjusted comparables consider supply chain geography to align with tariff risks. And as to business model, traditional comparables focus on operating leverage, whereas tariff-adjusted comparables prioritize import dependency ratio to capture tariff-specific vulnerabilities. In terms of multiple adjustment factors, we're going to continue by talking about supply chain flexibility, right? Supply chain flexibility is that we adjust multiples by 10 to 20% based on ability to adapt supply chains. For geographic diversification, we adjust multiple by 5 to 15% dependency, depending on the level of geographic diversification. For management track control or management track record, we adjust multiples by 5 to 10% based on management's ability to navigate tariff challenges. And finally, for financial strength, we adjust multiples by 10 to 25%, considering liquidity and financial resilience. So let's look at practical implementation for valuators. All right, so in terms of due diligence checklist, let's look at the supply chain analysis. We have to map suppliers by country, alternative sources, and contract terms. We have to understand the geographical distribution of suppliers and potential risk associated with concentration or reliance on specific regions. In terms of cost structure review, we have to analyze import dependency by product line. We have to evaluate cost pass-through ability to assess how companies can absorb or transfer tariff costs to customers. in terms of competitive assessment, we have to compare relative positioning versus peers, right? So we have to examine market share trends to understand competitive dynamics and resilience. As to management capabilities, we have to assess previous risk management experience. We have to evaluate strategic planning depth to gauge preparedness for future challenges. As to financial flexibility, we have to review balance sheet capacity, for example, cash reserve or liquidity. We have to check covenant compliance to ensure financial stability and operational flexibility. So let's look at practical implementation for evaluators. Here, we are going to look at the valuation process flow. All right, so in terms of valuation process, we have risk assessment. Here we identify and quantify risk related to tariffs, supply chains, and other factors. We use tools like scenario analysis to evaluate potential outcomes. Then we have scenario development. Here we develop multiple scenarios, bears, bull, it could be bears, bull, bear, or stress to account for different tariff environment. Here we consider probabilities and impacts on revenue, costs, and valuation multiples. Then we have model adjustments. We have to modify the DCF models, market multiples, and other valuation approaches to reflect tariff impacts. We have to incorporate adjustment for cost structures, discount rates, and other relevant factors. As to sensitivity analysis, we have to test the sensitivity of valuation results to changes, right, in key assumptions. We also have to ensure robustness of conclusions under varying conditions. As to documentation required, where in terms of supplier consultation analysis, we have to identify risk concentration and potential vulnerabilities. As to import documentation, we have to provide, it provides us data to calculate tariff exposure and assess cost implementations. Competitive pricing analysis. Here we evaluate whether companies can pass on increased cost to consumers. And mitigation plan details, we have to assess the effectiveness of strategies implemented to manage tariff impact. All right, so common valuation errors in tariff analysis. All right, so critical mistakes to avoid, right? Linear extrapolation. Here we assume linear extrapolation assumes that current tariff impacts will persist without change, leading to inaccurate valuations. And then correction involves using scenario-based modeling to account for potential changes over time. Then we have ignoring competitive dynamics. This fails to consider how competitive or competitors are affected by tariffs, right? Leading to incorrect assumptions about market share. Then we have corrective action that includes analyzing competitors' tariff exposure to better understand relative positioning. Then management optimism bias, right? So that's another mistake, common error that valuation professionals do. Here access management mitigation plans without critically evaluating their feasibility. Mitigation requires probability-weighted implementation success to assess realistic outcomes. Static cost consumption. This ignores dynamic changes in cost, such as supply chain adjustment or input price fluctuations. Time series cost modeling helps capture these changes more accurately. And discount rate errors. Okay, I assume this is the last 5 minutes. Is that right, Shana?
Yes, that is correct. We'll still have 5 more minutes left of the presentation.
Okay.
Thank you.
Achille,
Yes, sir.
this is a very timely and a phenomenal presentation. Quite frankly, I haven't heard a presentation that I've been so impressed by in the last year. So I want to congratulate you.
Thank you.
However, the model appears not to take certain things into consideration.
Okay.
And I can only lend you some of my personal experience. I live in Canada,
Mm-hmm.
which is one of the largest trading partners of the United States. The first thing that impressed me about your model is the 3-year timeline in terms of companies adjusting to the new fact situation on the ground.
Mm-hmm.
The tariff policies may not have a 3-year half-life, which creates additional risk to businesses who try and respond to them.
Mm-hmm.
I won't say anything further on that because that's a Pandora's box. I'll give you one example of a Canadian company. It happens to be run by the province of Ontario, which is like a state. Ontario has about 60% of the gross national product of Canada.
Mm-hmm.
So it's close to the gross national product of the state of California. Ontario controls the alcohol industry, the government itself, and purchases and retails all alcohol bought. Earlier on this year, it was decided that no bourbon was going to be allowed to be imported from the United States. Huge impact on American business. There's no elasticity there. Those businesses are being impacted.
Absolutely.
In terms of the wine industry, the province of British Columbia has noticed that there's a 50% increase in the sale of white wines
Mm-hmm.
and 30-some% in red wines. That has definitely affected California. In terms of aluminum, over 50% of the imports of aluminum to the United States come from Canada. 3 years will not be enough time to adjust for that because the main input in aluminum is energy, electricity. It'll take more than 3 years to build the power generating stations required to make aluminum. And that doesn't even take into consideration whether or not the power can be generated on a cost-effective basis.
Mm.
Okay?
Yes.
And I just want to give you those examples. And I'm just wondering, and I'd be willing to even work with you, how to incorporate that into your model.
Mm-hmm.
Because there are things that are happening which will take maybe a generation, a half-life of a generation to respond to.
Right.
Because this is not something that's going to be resolved during the current administration, this presidency.
I agree.
But it also creates huge opportunities. I remember one of the words that I learned in Chinese, the word for opportunity and crisis is the same word. So there will be opportunities here, which will also enhance, even when we think of some of these events as being negative,
Mm-hmm.
opportunities that will enhance and make some companies, businesses, that much more profitable.
Right. Okay. So
I've left you with a number of things, but I think you can appreciate how model and your presentation, as excellent as it is, there's a much broader
Mm-hmm.
qualitative and also quantitative
Mm-hmm.
factors to consider.
Right. Definitely. We don't need, I mean, are you okay? Are you done? Or maybe, can I answer now?
I'm sorry?
Can I answer a little bit?
Absolutely.
Sure, because we're running, time. Well, this is a study that I undertook because I think at this micro level, the micro level where business valuation expert where we operate in general. And most of business valuation experts do valuation at the macro level. And so we have to try to understand how this tariff is impacting small businesses that we work with every day and try to incorporate that risk and account for it in a way that is defensible in court, for example, right? So that makes sense to the IRS and things like that. So, but we have no model right now to work with. There's no model that we can use to assess, the exposure of these small businesses and based on that exposure, try to see how we can adjust our valuation, whether it's a DCF or market, multiples, how you can adjust our valuation results to account for that. And then plus there is an element of double dipping that I haven't exposed, I haven't talked about here yet. So we have to also be careful with double dipping, right? So which is an element where we sometimes we double dip without even realizing that we're doing that. So that is very it's detrimental to the company if we assess them with the same risk twice or maybe multiple times. So for example, this situation is unfolding in 2025. What is going to happen in the next few years? Is it going to be permanent? Is it going to vanish with this administration? It's just a lot of unknowns at this point. And so, but we are experts. We can't sit by and just watch and don't do anything. So that is the idea of coming up with this model. And so it could be evolving, as situations change on the field, or stabilizes or remains static or the same. It may evolve and we may adjust our model accordingly. So I welcome your input in this, and that's very much what we're looking for here, because when we discuss these issues in the public, we are looking for inputs from various people or sources that could help us better this model. But this is a good starting point that we can use for our daily valuation work that we do.
Thank you, Achille.
Appreciate it.
All right, Achille, looks like we're at time. Do you have any closing remarks? Any comments real quick before we end? I know we get some other information too, but we are at time.
All right. So I'm going to stop sharing.
Oh yeah. I just wondered if you had any closing comments or anything before we do that. Are you good?
Okay. Thank you.
Okay.
Thank you, Ekeu, for this wonderful presentation.
Appreciate it. Thank you, everybody.
Thank you, Achille. Bye. Thank you, everyone.
Thank you very much.
Appreciate it. Thank you.
Thanks everyone for joining us. And our next show will be on November 24th, 2025. So we look forward to seeing you then. Thanks again for joining us, everyone.